On this week's episode, I'm excited to bring on Bronson Hill as a guest. Bronson is a managing member of Bronson Equity and is a general partner of over 2,000 multifamily units worth over $200 million. Bronson is the host of the Mailbox Money Show, and he understands the investor mindset because he's spoken individually on the phone to over 1,300 investors, and he's raised over $30 million for his real estate and his ATM machine fund deals. Bronson is also the author of How to Use Inflation to Your Advantage and is a regular contributor to YouTube and his blog. Introducing managing member of Bronson Equity, Bronson Hill. Welcome to the Vijay Kaila Show, everyone. On today's episode, I'm excited to have Bronson Hill join us. Bronson is the managing member of Bronson Equity, and he's raised over $25 million in real estate deals. To date, he is a general partner of over 2,000 multifamily units worth over $200 million. Bronson, welcome to the show.
Hey, Vijay, I'm excited to be here. Love talking finance, investing, entrepreneurship, all the above. So super excited for the conversation.
I'm super excited for this as well. I mean, right before we talked about this, you said you're in California, and connecting that with real estate, I mean, it's a crazy market in California. I don't think you invest in California, do you?
No, I don't own anything in California. So I rent the house I live in, and we have our, over 2,000 units in Florida, Georgia, and Alabama. So for a number of reasons.
Okay, well, that's I think a perfect segue just to talk about the reasons why you don't invest in California, even though you live there.
Yeah, so I was telling somebody this story earlier on another interview. Just I live in California, in LA. The average house in the area I live in, or the house, I have a 3-bedroom, 2-bath house I rent, and rent is $3,500 a month. It's a nice little quiet neighborhood. It's the cost to buy would be about $1.2 million. And it's, we're talking 1,250 square feet. So not very big, but if I decided to buy this house, I'd have to put probably 10% down. So 120K down, maybe a little less, but probably about 10% down. And then my payment would be, especially with the rates rising, it used to be about 7K a month. Now it's probably about 10K a month. Just in the payment. So I'd be paying almost about 3 times what it would be to rent, which is insane. So to me, I kind of look at both the cost of the payment, which would be much higher, but also the opportunity cost of the 120K that I can invest. I know I can get at least 15% or more investing in deals elsewhere, whereas I see a lot of risk in the single family space. So to me, one of the reasons is just the cost of everything here versus what you're getting paid for rents or the potential to rent, as well as just a lot of the different challenges with a tenant-friendly state where you just can't evict people. There's a lot of rent controls or statewide rent control versus Florida. I mean, you can do the renovations and you actually can see the increase in rent, which is awesome for investors and our partners.
Got it. So it just does not make sense financially to invest in California.
I don't think so. I mean, there's people that do it. I run a meetup in Pasadena, California. We had about 40 people there last night. And there's a guy who does, you can do very well in California. It's just, again, I think it's another type of process. Like because my, investments are far away, I've got to have really good team members that work on the asset management. But the plus side is I never get calls at night of, hey, you got to fix this toilet, or we're having an issue with a tenant, whatever. I just got to have people in place to do all this stuff, right? So the fact of having an out of area team, it really makes you, forces you to really trust your team that you're working with too.
Got it. So the fact that you invest in different states and you're not physically there force you to create a system, build a team so it can run like a machine without you.
Well, I think that's really the secret to grow a business or an investment. Or a lot of people think, hey, I'm going to do real estate and I'm going to become financially free. And they think single family. And then, I had 4 or 5 single family houses and I realized it was a ton of work. And then I realized, this question, there's a guy named Dan Sullivan who leads Strategic Coach. I've never heard of Dan Sullivan, but he's written a number of books. He's a great guy. But he says, if you ask most entrepreneurs or most people, is it easier to double the size of your business or 10x the size of your business? He would said it's actually easier to 10x the size of your business, because when you're trying to double the size of your business, I got to work twice as hard. I got to buy twice as many houses. I got to work twice as many hours. You're just thinking versus when you go 10x, you've got to let go of about 90% of what you were doing before and really think in terms of scale. So I think in some ways it is just that question of doing out of state or out of area stuff. I can scale as big as I want to scale. I don't have a limitation as far as my time, versus if you have 5 or 10 houses locally and you're managing them, there's very limited on what you can do. And a lot of times we undervalue our time.
I think that's so powerful. It's easier to 10x your business than it is to double. I never even thought about that way, but you're absolutely right. When it comes to building systems and building something that can run without you, rather than doubling your efforts, you have to work smart to get that 10x growth.
Exactly. And a lot of people, they don't think in terms of that. We're not really taught that. It feels uncomfortable and unnatural. It feels just very different. But again, if you're setting things up where you can scale, it allows you. And a lot of us, we start with what we have. We start with a house or two or whatever we can do. But eventually, it's like, man, I was a busy professional getting paid well, and I thought, man, I don't want to manage any more property. I want to actually invest and have somebody else do it for me, or I want to bring partners in and I want to scale my wealth. So I've used kind of that strategy to basically 20x my net worth in the last 4 years, just by using other people's money and being able to really create partnerships that really make sense.
Well, I think let's talk about that. How are you using other people's money to 20x your net worth in 4 years? That is mind blowing. So let's talk about how you use other people's money.
Yeah. So basically, in real estate, what I realized is, you can do an apartment, or a single family house, or maybe a duplex. There's people that do this, and then you can renovate it, move to the next one. But it kind of goes with the same thing. Eventually, no matter how big you are, you're going to run out of money. You're not going to have any more money. And so what I realized is there's this whole group of people that, are doctors, lawyers, business owners, or retirees, and they would love to own apartment buildings, but they don't want to have to manage it. And so what I realized, if I could create a compelling offer for, hey, we'll basically, our team, that one of my partners has 28 years of experience and 13,000 units, and here's our track record, and here's everything we're doing. If I can create something around, hey, this is a tested, proven method and a group that's awesome in a great market, that people were very interested in being involved with that. So how I first started it is I had been doing single family. I had a family, a relative that I had got in touch with, and he'd been doing multifamily for years. And my plan was to get 30 houses myself. And then he's like, why don't you just raise money for multifamily? And I said, well, how do you do that? And he said, it's this thing called syndication. And what it is basically, it's just a legal structure that you use to help raise money from different people. So you pull it together to buy a multi-million-dollar project. So I had started this meetup that I mentioned earlier 4 years ago in Pasadena, California. We had 60 people at the first meeting. And I met a guy at that meeting who said, hey, I'd invest in one of your deals. And of course, at this time, I didn't have any deals. I wasn't an expert, but I was able to connect him with a guy who had a deal, was looking for money to raise money for the deal. And I used that to become a general partner and kind of get some experience. Then after that, I was able to find another partner who had a big platform, meaning they just had a huge online presence, but they were having trouble raising money. So I came on board to help. Let me take some calls with investors and try to help kind of onboard people to how the process works. A lot of people just don't know how it works. So over the next 18 months after that, I had 1,000 one-on-one phone calls with investors, and we raised $15 million. So again, it sounds crazy to think about now, but I never imagined I'd be doing this. I quit my great corporate job. I was making $200 to $250 a year, doing medical device sales. But about a year ago, I was able to leave. And it really was through this power of leveraging, creating value for other people, raising money. And by doing that, I was able to share in the upside of these deals, which is really amazing.
That's incredible. Congratulations on leaving last year.
Thank you.
So for the audience, could we talk about what the difference between a GP versus LP is, general partner versus limited partner?
Sure. Yeah. So syndication, it does involve two different groups when you buy an apartment. Typically, what we do is we start an LLC in the name of the property. So we have one in Jacksonville called Magnolia. So it'd be like Magnolia Property LLC or whatever. And of that company, we created an operating agreement stating that the general partners of the GPs, which is myself and my team, are the ones running the property. So we're the ones that are actually making the decisions. Who's the property manager? How are things performing? We're doing site visits. We're doing all the stuff to make sure that property performs, that the returns are what we are projecting, or hopefully even better. And then a limited partner is, they typically are, they don't have any responsibility besides just vetting the team and vetting the deal. And then they invest, and then they get what's called mailbox money. And that's the name of my podcast. It's called the Mailbox Money Show. It's just basically around the idea of truly being passive in an investment. Now, there's no such thing truly as fully passive investing, because nobody cares about your money the way you do. But the fact of you can vet a team and vet a deal and then get into it and then just receive the cash flow is really awesome. So, and then also another thing that's interesting for limited partners is that if there were a loss in the property, we've never lost money on a multifamily deal, but if there was a loss or a lawsuit or anything, the losses are limited to what the amount that a limited partner puts in. So it's kind of nice to know that if somebody's really wealthy and they put 50 or 100,000 in a deal, it doesn't put their other assets at risk, which is really great for a lot of investors that are concerned about that.
So the LP is a very passive estate where you don't really have to do much and you get the legal protection, you get mailbox money, like you said.
Exactly. Yeah. And a lot of people, they actually, they do it for different reasons. Some people do it for cash flow. Like for me, I realized like there's different ways to become financially free. I think the easiest way is to look at what are your modest living expenses. So even though I was making 200 to 250 a year, I realized I only needed about 60K a year to live well enough. I live pretty simply. Like I mentioned, I rent, there's different things that I do. I travel quite a bit, but I didn't need a lot of money to be able to live just on my basic expenses. So once I had enough cash flow from my passive investments to cover that, I was free. And I realized, oh man, I could leave my job and I'm free. And everything else I do is just kind of bonus on top of that. So, a lot of people do it for that reason. They want to retire. Other people, they want to just grow their wealth. They have a retirement account. Actually, people can use retirement accounts to do this as well. But again, it sounds like a foreign thing until someone has actually done it, or maybe they've met somebody who's done it. And then it starts to become, oh, wow, this is amazing. I don't have to do just stocks and bonds. I can actually do other things in real estate where I don't actually have to do the work. And it feels really magical when people kind of get that.
That's absolutely right. So with stocks, there is a lot of advantages. There's disadvantages. With real estate, there's advantages and disadvantages. But what do you think is the primary driver that people get into real estate and away from stocks?
So I think a lot of time, I was an investment advisor for a few years while I was doing the medical sales. I was an investment advisor, and I just got to kind of see, behind the curtain, if you will. So, the idea of the Wizard of Oz, that thing of pay no attention to the man behind the curtain. And you realize like, wow, this Wall Street thing, like, this really is not set up to really help investors. It's really set up just to charge fees from everybody. Tony Robbins came out with a book called Money Master the Game. And it said that the average mutual fund will say the fees are 1.2%. But when you look at all these hidden fees, which legally Wall Street does not have to disclose, it's more like 3.2%. So when the average returns are more like 5 to 7% or 5 to 8% per year, they're taking most of your money. So when I started to see some of that stuff and just see some of the hidden things, I realized these are not out there to serve investors. And secondly, to be a traditional investment like stocks and bonds, they're incredibly volatile, particularly stocks. I mean, you've seen multiple times stocks go down by 30 to 50%, even this year with stocks. Some of the indexes have gone on 30%. So people are just buying and holding. You can get kind of destroyed. And so looking at the higher returns of multifamily, looking at, we see commonly especially with a value add approach where we're doing renovations on units and things like that, we're seeing it's not uncommon to see a conservative return of 15, 16% per year. And obviously it can perform better or worse, but we've seen some just home runs way beyond that. So when people start actually looking at the asset class, it's very, very compelling.
Got it. So with interest rates increasing right now, we're recording this in October 2022. How is that impacting your holdings or future investments?
Yeah, it's a great question. Interest rates have risen sharply. I mean, from 6 months, 12 months ago, it was 3% for interest rates. Now, single family interest rates are about almost 7%, which is like a 41% increase in the payment, which is crazy. So we just had a panel last night about this, and we really think in general, because inflation is high, in my opinion, is not 8% or 9%. I think it's more like 15 to 18% when you count in, they do all this substitution, and there's all these ways that they fudge the thing. But if you look at a site called Shadow Stats, it uses the 1980 inflation metrics, and it shows we're about 17, 18%. So if that's the case, the challenge is really, what do you do with your money? Because if you just hold your money, the confused mind will say, I'm just going to wait. But if we wait 2 years, we could lose 35 to 40% of our purchasing power just due to inflation. So I love buying assets that pay me to hold them. Now, even if I'm paying 6, 7% on interest for an apartment building, I'm still paying less than the rate of inflation. And I have something that has a lot of upside in the future. So I'm not as big on single family right now. I think single family, just from an affordability standpoint, I think there has to be some pricing, maybe pricing will come down a little bit there. But we also have, on the other hand, I'm sharing a lot of different things. There's a lot of factors to this. And I know with your financial background as a CFA, there's a lot there. But there was this huge money drop that happened in the US where they dropped, it was 40.9% new currency physically or digitally, between over a 2-year period, February 2020 to February 2022. So that's just this massive amount of currency. So that is also a very inflationary factor. So over time, if you look at rents and you look at inflation, they really go hand in hand. So if you're buying commercial property, rents are there. We're seeing rents rise all over the country, especially if we're buying in growing markets like we buy in Jacksonville. There's no place I would rather have my money, even at an interest rate of 7 or higher, than in multifamily real estate. So that's my opinion.
That's really interesting. So one of my friends actually, he reached out to me. He's like, Vijay, I want to buy a house because, live in one room, rent out the others through house hacking and all that. And I said, interest rates are super high right now, but the stock market's down 20 to 30%. Why would you buy when interest rates are super high and not buy stocks and just ride out for a few years? You'll probably make potentially a higher return investing in stocks right now, short term. And I just wanted to hear your opinion on that because I invest in both. I have big stock market portfolio and real estate as well. And so it's kind of, I love both asset classes. It's just right now, it seems like stocks may be a better way just because we are down 20 to 30%.
Right. And, we're always looking for something on sale, right? We're always looking for something that we can find a deal on. When I look at stock valuations, there was a really good book that came out called Rule Number One by a guy named Phil Town. And it just talks about kind of how the layperson can actually analyze what is a stock worth, just do a very quick back of the napkin kind of evaluation. And so what he talks about is kind of historical price earnings ratios, right? So I'm not sure where they're at right now. I know when they were kind of at the peak, 30% higher, or, whatever they were, close to like 1929 levels of, between 30 and 35 of PE, just meaning how many dollars are we paying for $1 of earning on average? And it was so around $30 or $35, where the historic average in stocks, if you look over the last, 60, 80 years, 100 years, is more like a 14. So I'd imagine we're still kind of above there. And again, there goes swings where you're way high and then you're way low. And so, I mean, I think, it depends really what your strategy is. If you feel like you have an edge in stocks and you're looking at certain, more than just doing index stuff, I think if you look at certain businesses and you feel like you have an edge there, but whatever you have an edge in, whatever you feel like you can understand. I had a really great panel recently. We were talking about that. Just, invest in what you feel like you have an edge in. So maybe there's a way that with single family, you come in and you're a single person and you've got a 5-bedroom house and you're able to rent it out and rent the rooms out. Maybe that's a great deal right now. And the guy who was making this case last night is in the lending field. And he was like, hey, if you buy, the more we buy right now, maybe in the future you buy at this higher rate now, but as rates go lower in the future, because likely they will eventually go lower again, you can always refinance. So there is some thought to say that that's wise as well. But everybody's got a strategy, and you got to find out what works for you. And I'm not anti-stocks. I just think, I want to see. I think there's a saying of when there's blood in the streets, right? And, what do? Is you wait, be fearful when others are greedy and be greedy when others are fearful. And I'm just not seeing the valuations of single family come down a lot. I mean, stocks come down a little bit, but I think there could be some incredible opportunities in the near future.
I think that's a great answer. It's know your asset class and go deep into it. So that's a great response with that. Let's talk a little bit more about inflation and how this could be advantageous to real estate investors.
Right. So a lot of people these days, inflation is terrible. We're getting the pain at the pump. I'm in California, which it's funny. I've traveled quite a bit. So I was in Texas. It was $2.80 a gallon. This is 2 weeks ago. We're paying $6.70 a gallon in California. I'm like, and they're saying, oh, it's the extra taxes or it's the retooling for the winter blend. I'm like, to me, it just feels like corruption. I don't know what else to say, but anyway, so inflation, wherever you live, inflation is high. Gas prices are up. The pain at the pump is real. Also going, getting food or just all your different costs and your energy and different things is there. So a lot of people feel like they can really get hurt by that. Now, the way wealthy people and the way really smart people get around this is they try to get on the other side of the equation to say, what if I buy, what is it I'm going to buy or put my money into that is actually going to hedge inflation? So what I try to do is, real estate is an incredible way because you get to use leverage to buy assets. So just that in itself, even if you don't have inflation, is huge, right? Because if we put 20 or 30% down on a multifamily property, which is usually what we raise, and we finance the rest, we don't, if the property increases in value by 20, 30%, we haven't, increased our equity by 20, 30%, we've doubled our equity, right? Because we're using leverage. So just the fact of using leverage is huge. It's a very stable asset. And then we know these assets are going to be worth way more in 5-10 years than they are right now. Well, why is that? It's because they've created a ton more currency, and there's a limited supply of housing. We're short, somewhere between 3 and 8 million apartment units, depending on which source you look at. So where there's a huge shortage, we know these assets in the long term is going to be worth way more, and we get to pay them off in future dollars that are worth less. In addition, we're borrowing below the rate of actual inflation. So there's all these benefits to it. So if you want to take advantage of it, you could try to take out debt to go buy assets that pay you to hold them, that you know will be worth more in the future, and you pay them off with dollars that will be worth less. So, I mean, to me, it's the best way. I think there are other ways, but I think that is the best way.
Incredible. Yeah. Using debt to your advantage is so powerful. And everything you mentioned is the reason why I love real estate so much. So I completely understand exactly what you're saying. For people in the audience who follow Dave Ramsey's advice about paying off debt, how would you approach that conversation?
So honestly, I used to be, don't listen to Dave Ramsey, he's terrible, whatever. I think honestly about 80% of people really need Dave Ramsey. I would say Dave Ramsey, everybody should go through Dave Ramsey's stuff. It's kind of 101, no credit card debt. If you have credit card debt right now in your life, the best investment, you might be like get a 20% return just for paying down your credit card debt. So that's huge, right? Or in general, staying out of debt is a good idea, but there's good debt and there's bad debt, right? So bad debt would be credit card debt. There'd be other types of debts, but maybe a student loan payment that's 4.5%. Maybe instead of paying that off, maybe there's ways that could be invested to go get higher returns. So to me, I think there are ways to get good debt, such as investment real estate. Another example of this, these are hard to find now, but I found a bank in California that gave me a personal line of credit that's non-recourse, meaning they can't go after other assets. But basically, they gave me $100,000 for a 2.75% interest rate. And they did it so that I brought an account over and everything. But so I took it all out. This was about a year ago. And I just invested all of that because I'm like, man, I know for sure I can get a much higher return elsewhere. And then I was able. It was the first 2 years were interest only. The last 8 years are more of kind of a fixed, almost like a mortgage. And so those type of opportunities exist. And so a lot of people say, well, that's not even real. It's like, well, why would people do that? Why would banks do that? Well, they're trying to get business. So there are opportunities out there to take advantage of debt. So if I know I can borrow it at a low rate and have a high degree of certainty that I can put it in deals that will return more, obviously I have to consider risk. I'm not telling anybody you should do this, but I'm just saying for me, it's been very helpful to find safe ways or maybe diversify or do some things around that because I know, I can get a much higher return that way.
And I would mirror that 100%. The reason why I was able to leave my job earlier this year is because of debt, right? You borrowed money from my HELOC, fund my business, get enough cash flow coming in. Like, great, able to do it. So if you use debt properly, exactly like you said, you can achieve such a high level of financial independence. And that kind of brings me to my next question. How can people get started investing in commercial real estate? Usually you have to be an accredited investor, join a syndication, or, based on the syndication, but how can the everyday person get started?
So there's really two ways to start. Really, either you have time or you have money. In my case, I didn't really have both. I mean, I had a good job, but I didn't really have any savings. And so I had, I just was in a kind of unique spot. And so what I realized is I wanted to leverage my time. So I thought, hey, I'm just going to try to learn as much as I can around this. I'm going to go to as many events, start a meetup, just do whatever I can to be in the space, to try to network and add value to others. And I found a way to raise some money for a deal. So either if you want to be on the active side, kind of like what we do, then one way is you either start by raising money and you try to tell your friends and family, create a list and just start telling people what you're doing, go to events, that kind of thing, and network. Or you can be somebody who's on the phone with brokers and trying to find deals. So one of those two ways are usually how people start on the active side. If you want to be passive, if you're somebody who has a business or you've got you maybe are a CPA or a professional or something like that, a great way is to learn about how it works. We've got this report on our website that's how to use inflation to your advantage. It's a 50-page ebook. It's for free, just a free download. Talks about, some of the things we talked about here, as well as how to get started in multifamily. So the best investment I think you really can make is in your own education. And it's through reading books, going to, listening to podcasts like yours, and just really trying to educate yourself. And then also the power of networking, actually getting in the room. I mean, I really can't understate that importance. And a lot of passive investors, they kind of shy away from that. I don't want to travel for an event, whatever. Well, when you go to an event like a national conference that's on investing or real estate investing in Texas or something, you're going to meet people from all over the country, and these people are super serious, and you're going to learn a ton. So I think just getting in the room with people that are a few steps ahead of you. There's a quote that says by Jim Rohn, who's a motivational guy. He says, "You're the average of the 5 people you spend the most time with." So if I stop and look around, what's my fitness level? How's my health? How's my finances? What do I spend my time doing? It's typically, if I just took your 5 closest people you spent time with, that would probably be a pretty good average of your net worth, of all these different things. So if you want to grow your net worth, if you want to grow your investing skills, if you want to grow in any area of life, you've got to get around people that are a level or two ahead of you.
Incredible advice. I love that quote. I use that so much. I
Yeah.
am conscious about who I spend my time with exactly for that reason. So thank you for bringing that up. I thought it was really interesting that you said you did over 1,000 one-on-one pitches. Is that what it was? Or how did you get in front of over 1,000 people to raise capital?
Yeah, so this was, I say it's been about 1,300 now, but people will join our investment club, or when I was working with my former partner, business partner, basically we have a process where people go on. So if somebody goes on and they download my ebook, there'll be an opportunity to, hey, join our investment club. If you're not on our, if we haven't had a call with you, you're not on our deal list, you're not hearing about these great deals. So typically we'll set up a 20-minute call just to, hey, let's get to know you. What are your goals? What are you looking for? Whatever. We take notes and then we start that financial relationship. And so some of our deals we can only pitch to people that we have that relationship with. We don't just work with accredited investors. Some of our deals are for non-accredited as well. So we like to just make sure that we're really communicating. We have a good relationship with our investors. And so, but yeah, it's a lot of calls. I mean, I can tell you a story. I've had sometimes 20 calls in one day, which, a lot of the same conversation back to back. And I'm a people guy, but that's a lot, right? So, but I just realized I did some metrics around it, and I realized every single call, it was like, if you averaged out, 1,000, I think we took 1,000 of those and we averaged them out, it was about 22% would invest. And the average investment size was 72,000. So if that was the case, then every single call I did, whether they invested or not, was worth something like $12,000. So I realized like the power of picking up the phone, getting somebody on the phone, talking, having a conversation, seeing if it makes sense. It's huge. So I try to get on the phone with as many investors as I can.
That's incredible. Okay, so you basically systematize this so you could find statistically how much each phone call can be worth for you.
Yeah. Yeah. Well, when you look at it, you look and see, well, how are we doing? How are we converting? And who's actually investing? What's working? What's not? And after a while, I mean, the beginning, the first 30 to 50 calls, you're kind of, no matter who it is, you're kind of floundering through it and just whatever. Then after a while, you kind of get a talk track down. Okay, this is what we're doing on this call. Here's, what we're going to talk about. Does that sound okay? You get some buy-in. And then you kind of walk through, hey, this is, some questions that we have for you to understand your financial goals. And then we say, these are our values. We like being very conservative. We like developing a long-term partnership. We don't necessarily want this to be a one-off deal. We would hope that in 5 years you've had a great experience, both from the communication, the performance, and then we just go through that, and then we answer any questions people have, talk about our process. And for us, it's really kind of an opportunity to tee investments up, because some of our investments fill up sometimes in a very short period of time, in a few hours or a few days. So we want to make sure that if people are interested, they know how that works, because they've never done that. That's telling people I don't know what to expect. So you're gonna have to really, set the table for me to know how this works. And that's the biggest thing I think you can do when you work with investors, is just give a good sense of, here's the expectations, here's what you're looking for, both from process and communication and all that stuff.
Got it. Could we walk through your funnel by any chance? Is that something
Sure.
you're okay talking about?
Yeah, absolutely. So a funnel for those that aren't as familiar, a funnel is just, how do you get people into your network? I've got several different funnels. The primary one I use to grow my list, which started with just really a couple hundred people, friends and family that we tell anybody who's trying to start raising money, which is really what we do, is to just, make a list of everybody you know, and they're, you went to school with, you went to church with, wherever you know them, and just put them on your list. Then you start communicating with your list. And then, you have things like a lead magnet. So they go to your site, and if almost every site you go to will have some, here, download this or get a free coupon here or whatever. And there's some way they capture your information and they start sending you information. So I have basically a way to capture through that. I have a weekly email that goes out that's got kind of a blog article, as well as some other, my podcast, other links and events that we're doing on there. And then a big way that's been really helpful is just last night, we do this once a month. We had a webinar called How to Fix the Financial System with 3 influencers that were on there. And so basically I'll invite my whole list, and then, hopefully they'll invite their list and they'll put it out there as well. And as they do that, if we all do that, more people come into my list. So I had an event last month that I did where 950 people signed up, and there was about 700 new people to my list. So my list went from 4,700 to about 5,000 just from that. And then I have, when these people join, I've got kind of a welcome series. It's just like, hey, welcome to Bronson Equity. We do these kind of events. We also do this, and just kind of gets people familiar with what we do, right? So there's some sort of onboarding process. So those are kind of the two primary ways. These are either it's through like being on a podcast like this, they find my, I call it a lead magnet, but they find my ebook and they'll go on and download that, or they'll go through one of these events. And then when they're there, I have kind of a welcome process. And then we just continually every email or every follow up, hey, join our club, join our club, join our club. And that's really where we're trying to get people to.
Okay. So do you have a low ticket offer, or is your only thing that you offer investment opportunities?
So yeah, right now, all we have is our investment opportunities. We do have some, we have our free stuff that we do. I'm in the process of trying to create a low ticket offer and maybe a high ticket offer. There are groups that do both. So maybe like a $97 a month, get exclusive access and deal flow and resources and courses and things like that, because I realized I could get people in there that were really interested and create a bunch of stuff for them. And then there is a group out there that's very wealthy that is typically net worth of 3 to 5 million or more. And I know of multiple groups where people join for 50 to 65K a year, and they're simply paying to have access to deal flow. So the fact of I'm in the middle of deal flow, and if I have deals I do or deals I want to bring to my group, I can do that in that kind of a group. So I'm considering starting with low ticket and then creating a high ticket something through that. So, but anyway, yeah, I'm working on that.
Yeah, that's really interesting you said that, because usually in business, you could either pay your way in or work your way in. And with that $65,000 item, seems like people are paying their way in. And you talked about how you worked your way in, just creating or raising capital for deals. Is that correct?
Yeah. I basically just, I think if you're, no matter what you do, I think if you're just willing to take action, you're willing to get on a plane, you're willing to get on the phone, you're willing to just continue to learn and, almost just kind of just go out there and take action. There's a wonderful book that I actually read before I quit my job. And ironically, the title is called Before You Quit Your Job. And it's by Robert Kiyosaki. It's another title of the book, the author of Rich Dad, Poor Dad, which is a great place to start as well if somebody's interested in getting started with real estate. But basically, he describes being an entrepreneur it's a very different mindset than being an employee. If I'm an employee, if I make too many mistakes, I'll get fired, right? But if I'm an entrepreneur, I have to make a lot of mistakes and be comfortable making a lot of mistakes. And I've got to quickly learn. And so this too, as an entrepreneur, you got to try different things. And our kind of tendency of, I don't want to make any mistakes. And just, we're taught that in school. We're taught that in our jobs and whatever. It's as an entrepreneur, you got to try a lot of different, you got to try new things. You got to be willing to fail and make mistakes and then just quickly learn all those things. And so in the book, Robert Kiyosaki describes being an entrepreneur as like jumping out of a plane without a parachute and trying to assemble one before you hit the ground. And I think that's a really good analogy. Like, it was funny. I read this book. My cousin said, "Oh, you should read this book before you quit your job." And I was like, "Oh, it sounds really cliche. Okay, I'll read it." And then I was like, "This is really good." But I think for a lot of people, it's, if we just take action and we take consistent action, it doesn't have to be massive action or today, okay, I've learned about real estate, I'm going to quit my job today. It could just be like, hey, I'm going to spend time looking at deals. I'm going to analyze them. I'm going to go to this conference. I'm going to go to a meetup every week. I'm going to listen to podcasts. All those actions, they compile and they start to generate this momentum in your life. And then over time, you meet somebody who is doing what you want to do, and you start asking them questions, and that actually becomes a transformational encounter, right? It's not just like information. People think it's information that, oh, I study this and I learn this. It's actually transformation. You go, and whether you, like you said, you pay to be in the room. Maybe I pay for coaching. Maybe I pay for someone to coach me on how to do this, and I actually get some of that from them. Then I learn I actually can do this. I've got support along the way, and I can actually get to where I need to go. So there are different ways to get there, but I think it involves just taking lots of action.
That's 100% right. Taking action, and before you quit your job, try to see if this is something you could do on the side until you run out of time, basically the number of hours in the day before you make that jump. So I think that's incredible that you did that.
Thanks.
Gosh, I want to just rewind the conversation a little bit. When you had these 20-minute meetings with these investors, potential investors, what was kind of the outline of the conversation?
Yeah. So I have a little script. If somebody wants to send me an email, I can send it to them. I'll give the outline now, but my email is just bronson@bronsonequity.com. But basically it's a quick little, how'd you hear about our group? How'd you hear about us? Because that's helpful for two reasons. One, I want to know just so I can know that I could do more of whatever I was doing. They heard about me. And secondly, from compliance reasons, it's good to have that. And then I asked them, what do you do for work and what's your real estate investing experience? Now, the person who, and I'm trying to figure out pretty quickly, is this somebody who's invested in 50 passive deals and they're going to be asking very technical questions? Or is it somebody who's maybe a doctor who's got $5 million in net worth, but they have only invested in stocks, right? Those are two different. So it's going to be a much more basic conversation of just kind of getting somebody familiar with syndication. So I got to figure out who's on the phone. And then from there, I say, okay, well, tell me, what are your goals? Is it more cash flow or is it more appreciation? I just try to, take as many notes as I can. I have a contact management system, so I put it all in there. I put it in a spreadsheet or something. And then I go through, what's your net worth? And I do ask the net worth question because I want to know, if somebody, and I've had stories where people get on and think, oh, I want to invest 50K. And it's like, well, what's your net worth? Well, it's negative, I'm in debt with all this school. And it's like, well, how do you invest with it? Well, I'll take out debt and I'll do. It's like, no, we don't want that. You got to have somebody that actually fits, it's got to be suitable for them. So you don't want to take money from somebody that they're borrowing or they don't have the money to do it, or it's going to put them in a bind. So we have some certain, net worth minimums and things. And then we really look at, okay, well, thank you for sharing all this. Well, this is what we do. And this is our buy box where we're doing properties in this market, this type of return, this value. When I basically lay all that out there, and then I say, does that fit your criteria? And usually I'll say, yeah, oh, sure, whatever. And then I'll say, well, let me share about our group a little bit. I'll share our core values. Like I mentioned, conservative underwriting, the idea of partnership, really long-term partnership with investors, and being very transparent on the communication, very clear on communication. And then I just maybe share an example or two of things we're doing, and then I'll kind of ask them, do you have any questions? And then I'll also explain what the process is. So again, when you go to Starbucks or you go to your favorite restaurant, you know exactly what you're going to get, right? Starbucks has done a great job of this. You go in and you get your double decaf, no-fo, whatever you're getting. Like they'll make it for you right every time. And even the attitude of the people will be very similar. It's sometimes you'll get some a little bit, but for the most part, it's very, very consistent. And so the thing is with people, most people have never done this before. And almost anybody, nobody's done it with you before. So you're going to have to set the table really clearly and say, well, this is how it works. This is what it is. And in the process of doing that, I also try to set the table that, our deals, I'm not trying to be dishonest and say, we've had deals that fill up in 24 hours, or we've raised, millions of dollars in a short period of time, and some people can't get in, and that happens. So, I try to tell them that, hey, this is a process. This is how it works. If you are interested, please let us know right away, just so that, we may have more space, we may not. And so that way you're kind of setting the table of what to expect next. And if they have any questions, they can reach out. So that's kind of a little bit of on how that conversation goes. So again, it's a getting to know you, it's hearing about them, getting that compliant information to make sure that I've got the information I have. So when I do have a deal, I actually can share it with them. And then, I feel like they've got enough information about our group that they can make a decision on, if they want to work together or not in the future.
Great. So you're asking all these questions so you could figure out how you could best serve your clientele.
Yeah, exactly. And sometimes, the answer is, somebody will say, hey, I'm looking for 100% return in 12 months. And I'm like, well, we're not a good fit, because that's not what we do, right? We're looking more like we're trying to double the money in 4 to 6 years, so that's kind of generally. So again, it's a really helpful thing. And then sometimes that's a trust building thing too. And you're saying, maybe you should talk to this other guy that does self-storage, or maybe you should talk to this person over here that does this other thing. And people see that. They know you're not getting any benefit from it, but they see that you're actually referring someone else. And I've had one guy refer probably 15 people to me just from, hey, I really like this guy Bronson, whatever. So that happens, and I really appreciate that. So you never know too, just by being a good person and treating people well, it's kind of like a karma principle, right? It all comes back. So how you treat people, it will totally come back to you.
Absolutely. So from a regulatory standpoint, are you a 506B or 506C?
Yeah. So 506B and 506C, the difference that, for those that aren't familiar, 506C is for accredited investors only. You have to have some sort of verification. You don't have to have a third party. You can actually just look at bank statements or other, tax returns or things. We do both. We've done, 506B is for accredited and non-accredited with a prior existing relationship. We do both, but we still like to, whenever possible, have a conversation with people just to make sure that we understand them. We've had some sort of record of a conversation. They've gotten to know us a little bit. It's a great best practice. But then, we've also, we have an investment in the ATM machine space. We've partnered with the 5th largest operator of ATMs. It's a very high cash flow deal. Happy to explain that if you like. But that one basically it's a 506C accredited only. And we've raised about $6 million for that in the last 8 or 9 months. So, we have different things we do. And we pitch that pretty much to everybody on our list, right? So we sent out one email that was like, hey, if you're interested in this, it's, it's going out wide and broad. And if people are interested, and people did reach out that weren't necessarily on our deal list.
Got it. The reason I asked for those listening about 506B versus 506C is that with 506B as in boy, you cannot generally solicit, as in you cannot advertise. So when Bronson was talking about sending out emails to 4,000 or 5,000 people, I was wondering how he was doing it from a regulatory standpoint, but it makes sense with 506C where you can generally solicit. And that's really interesting with the ATMs. Tell me more about that. I am definitely interested.
Well, let me say one thing too. When I send out 5,000 emails, or we have 5,200 lists. We're typically sending out to about 2,700 to 3,000 a week. Just people that are kind of engaged. We don't just send it out if people are not opening emails. And that's honestly most of what we do is education. So I have a lot of educational content. We're doing 10 videos a month on YouTube. We're doing podcasts. We do all kinds of stuff. So that's primarily what we're doing. Now, the ATM machine fund, when I first heard about it, I was super skeptical. I was like, man, this just sounds weird. Like, why, is this a scam? What is this? But I had some friends that have been doing it for years, over 10 years. One of my trusts of my life, and they had done all kinds of diligence. This is the 5th largest operator of ATMs in the country. Over 15,000 ATM machines, mostly in the Northeast. And they went to New York City and went around and gave me a list of all your ATMs. And they went and checked and spot checked and made sure all of those ATMs were correct, that they were there, their ATMs. Want to make sure that these particular ones were there. And so I invested a little bit a couple years ago, and then I did some diligence myself, went out, background checked every single person on the operations team. I went out and did a random check in Pennsylvania and made sure that, again, same, the ATMs were there, they were labeled correctly, they were their ATMs. And so how it works, it's a very unique investment. We only offer it a couple times a year. It's 100K invested, produces around, it's a 24.7% preferred return. So that means starting month 4. So we just closed one in September. So we expect, and it's not guaranteed, but we expect that will start cash flowing January 28th, and will pay out $2,200 a month based on a 100K investment every month for 7 years. So you get about half your money back in 2 years. And in 4 years, just over 4 years, all the capital is returned. And the last 3 years are just cash flow. So, having something like that, especially today, where it's like, there's no interest rate risk. It's high cash flow, and you get a lot of your money back soon. It also has 100% depreciation, and it has no recapture. So a lot of times with real estate deals, when you sell, there's this recapture event. This one doesn't have that. So it's really the most predictable cash flow deal I've ever seen. They've never missed a monthly payment. It pays out monthly. They've never missed a monthly payment in doing this in over 10 years. So it's pretty solid. So I feel pretty excited about it. A lot of people that invest in ATMs, they're not the ones that use ATMs. Like, I haven't paid for a fee on an ATM in years, but there's 5 to 10% of the population. They're the unbanked, they're the underbanked, the people that have cash businesses or immigrants or things like this. It really is their bank, and they go use it every week. Government benefits now come on a debit card. So they go to an ATM machine, they pull it out, they can send money through it. It's just, people that don't use ATMs, they don't realize how many people actually do use ATMs. So it's very interesting.
That's really interesting. So what is the minimum? I know you mentioned 100,000, but is that the minimum to get in?
So this is unique. It's when we offer it, it's $52,000 increments. And the reason why is it just gets easier with monthly distributions. We call that like one unit. So people put in 52, they put in, 104. We've had, somebody put in 700 and some, just based on, it just depends. So again, to me, having that kind of cash flow is really amazing. So a lot of people put a little bit in, and then they'll kind of like, oh, I've got some more money. What should I do? And then they put more in, and it's been a lot of fun to be a part of.
That's amazing. Okay, I'll definitely put all that in the show notes. Well, Bronson, this has been an incredible conversation. Where can our audience get in touch with you?
Yeah, it's just been a lot of fun, Vijay. I really appreciate you having me on today. I love the questions. So you can go to my website, bronsonequity.com. Like I mentioned, we've got this How to Use Inflation to Your Advantage 50-page ebook. Just talks about how to get started in multifamily investing, also some other assets such as, I do some stuff in precious metals or even some crypto stuff. So just, kind of how that would work in an inflationary environment. If you're interested in joining our investment club, there's a join button there. You can join and get on our deal list as well. So this has been awesome, Vijay. Thanks for having me.
Of course, I'll put all this in the show notes. Bronson, thanks so much for your time.
Thanks, man. Appreciate it.